Today, we're diving into a huge shift in economic thinking, a change that could totally reshape your personal financial strategy. We're going to connect the dots from what's happening on a national level directly to your wallet.
So let's just start with a really big question, something that kind of flips our whole understanding of taxes on its head. Just imagine for a second, what if the money you make from your job wasn't the government's #1 source of cash? What would that even look like?
And this isn't just some crazy what-if scenario. It's a real proposal being talked about right now. The idea is to go back to an older model where tariffs, taxes on goods brought in from other countries, are the main way the government gets its funding. The stated goal? Simple. As taxes on foreign goods go up, the hope is the taxes on your income and on American businesses can come way, way down.
So here's how we're going to break it all down. We'll start with the huge 30,000-foot view of this economic plan. Then we're going to zoom all the way into the specific, practical things you can actually do to navigate this new world. All right, let's get into it.
Believe it or not, this isn't some brand new futuristic idea. It's actually a throwback. We're talking about a time before 1913, before there was even a federal income tax. Back then, the government ran almost entirely on tariffs, so this is a massive rethinking of how the country pays its bills. The basic idea is really pretty simple. Stop taxing what we make and do here at home so much, our paychecks, our company profits, and start taxing the stuff we buy from other countries instead. It's designed to be a 1-2 punch. Bring in money from global trade, and at the same time, give companies a real reason to set up shop and create jobs right here in the US.
So how do you actually make a shift this big? Well, policymakers are basically pulling two giant levers at the same time. Lever number 1, crank up the revenue from foreign goods using tariffs. And lever number 2, cut the direct taxes that Americans and their businesses have to pay.
And that first lever, it's already making a huge financial splash. Recent analysis showed that the new tariffs are pulling in something like $29 billion every single month. That's a pretty serious new revenue stream for the government.
Now, what's so important to understand is that these tariffs are not just a flat tax on everything. Not at all. As you can see here, they're incredibly strategic. You've got these really targeted rates, some as high as 145% on goods from certain countries, and then big tariffs on critical materials like steel. This turns tariffs into a really powerful tool for negotiating trade deals and protecting our own industries.
Then you have the second lever, which is all about cutting taxes at home. And we've already seen this in action. The 2017 tax reform, for example, lowered the income tax rates for most people. You can see how the 25% bracket dropped to 22%. And maybe even bigger, it took the corporate tax rate and slashed it from 35% all the way down to 21%. Okay, so we've talked about the big picture, the national policy, but what does this actually mean for you, for your bank account? Well, this new landscape with its lower income taxes and new incentives really demands that you get a lot smarter about how you set up your finances.
And this is where a really powerful strategy comes into play, something that financial experts are calling the T formation. It's a surprisingly simple concept, but it's incredibly effective. The whole point is to build the legal wall between the things you do to make money and the valuable things that you own.
So at the very bottom, the base of this whole structure, you have a trust. This is the bedrock. It's all about your long-term plan for your estate, for your legacy, and for making sure your wealth gets passed on smoothly. Okay, now picture that T. On one side, let's call it the left arm, you've got your operational stuff. These are the engines of your wealth. They're the LLCs that actually run your company, your side hustle, whatever it is that's out there making money, and importantly, taking on risk.
And then on the other side, the right arm, you have separate companies that do nothing but own things. That's it. Their only job is to hold your valuable assets, like rental properties or your stock portfolio. This separation is absolutely crucial because it protects your nest egg from any lawsuits or problems that might pop up in your business.
Okay, this is where it gets really fun. we've got the framework, the T formation, set up. Now let's talk about the high-powered tools you can plug into it to really supercharge your tax savings.
For your business, your operational LLC electing to be treated as an S-corp is a total game changer. Just look at the difference here. With a regular LLC, that whole $100,000 profit gets hit with a 15.3% self-employment tax. Ouch. But as an S-corp, you can pay yourself a reasonable salary, say 30 grand, and only that part gets taxed. The other 70,000, you take it as a distribution and it is not subject to self-employment tax. That's a huge savings year after year.
And the beauty of this T formation is that it's not one size fits all. You can totally customize it with different kinds of LLCs for different jobs. You could have a holding company just for your real estate to add privacy and protection, or a management company to handle the books if you have a few businesses. You could even set up a family LLC to manage your wealth across generations.
All right, let's get to the final piece of the playbook, the real grand finale here. We're talking about how to use real estate to unlock some truly incredible tax advantages inside this system.
Okay, there's a massive opportunity that experts point to, and it's often called the short-term rental loophole. Normally, any losses from a rental property are considered passive, which means you can only use them to cancel out other passive income. But this strategy lets you relabel those losses as active. And why does that matter? Because it means you can use them to wipe out the taxable income from your main W-2 job or your business. So how does this actually work? Well, it's pretty much a four-step process. First, you need a rental, where guests stay less than 7 days on average. Second, you do what's called a cost segregation study, which is just a fancy accounting method that lets you take years' worth of depreciation deductions all at once in the first year. Third, you have to materially participate, which usually just means spending at least 100 hours a year on it. And the result? A giant paper loss that you can use to slash your overall tax bill. Let's make this real. Check out this example from an expert analysis. You've got a lawyer making $300,000 a year from their job. They buy a short-term rental, and it brings in another $70,000 in cash flow. So their total income is now $370,000. And boom, look what happens. By using that short-term rental strategy and the cost segregation, they generate a massive paper loss from depreciation. Now, this isn't a real loss. They're still making money. It's just a loss for tax purposes. And it's so big that it completely wipes out the $70,000 in rental income and a big chunk of their salary. At the end of the day, their taxable income drops from $370K all the way down to $210,000. We're talking tens of thousands in tax savings in year one. So what's the big takeaway from all this? It's that these huge macroeconomic policy shifts we started with, the move toward tariffs, the lower income taxes, they create a whole new set of rules for the financial game. And if you understand this new system, you can legally and ethically structure your own finances to take advantage of it. And that really just leaves us with one final thought. At the end of the day, it's not just about how much money you make. It's about how well you understand the system you're making it in. So as the economic playbook gets a rewrite, the question is, are you just going to sit in the stands and watch? Or are you going to get in the game? Thanks for watching.